All right, so guys, good afternoon, and you are welcome to the part two of the accounting process. Now, in the part one, we realized that there is an accounting process, and we go through by understanding our source documents, because the source document is the basis for recording any transaction. Now, in this time round, what we are going to do is to go through and do the next step. Now, the next step is what we call the books of prime entry, all right, or books of original entry, or general or the journals, all right. So that is that. So those are the names. Now we went through this. Now we are looking at recording into the books of prime entry. It's also called the books of original entry. So we're starting our recording process, all right. So now we talk about the books of original entry, also known as journals, all right, and also known as day books, all right, or books of first entry. This is the first thing that you are going to do, even as you are learning how to record a transaction in a financial statement, all right. So basically, that is it. Now, they are basically grouped under 6, but I added a little one to make it 7, because that one too is under 1 already. So you have here the types, all right? So we have the sales journal, all right? So the sales journal, what does it do? Anytime you hear that somebody has sold goods, now the focus is on goods, all right? If somebody sells goods on credit, it will go into a sales journal. So that is the most important thing. What you need to understand is these basics, because other than that, you will start facing challenges in accounting. So where do we start from? We say we will start from the sales daybook or the sales journal, all right? Or any name that you have, you can give it, sales daybook or sales journal. Now, the sales daybook or the sales journal, what is the focus for that? The focus is on selling on credit. Now, selling what? Selling goods on what? Credit. So if it is not a sale that was on credit and it was on goods, don't put it in the sales journal. So here the focus is on goods. Another name for goods is what? Stock, right? Another name for that is what? Inventory. All right, so that is that. So anytime you see sale of goods on credit, it will start in the sales journal. All right, so that is that. Then we have the purchases. So just as the sales is, the opposite of sales is what? Purchases. So purchases daybook. That one records what? The purchases of what? Goods on credit. Understand that. The focus is on goods or inventory or stock. So here we are talking about goods purchased on credit. Okay, so say, what if they purchase goods but it is not on credit? Then don't put it in the purchases journal. It will go to another journal. We will get to that. All right, so that is that. Now, these sales that we did, let's say we sold to Adjoa Mansa, then Adjoa Mansa decided to return some of the goods to us. That one, we will create another journal. We call it what? The sales return journal. That is the name, sales return daybook or journal. Now, what is another name or the other name for that? We call it what? Return inwards. So just so that you don't confuse yourselves, always call it what? Sales return inwards. All right. Sales return inwards daybook or journal. Why? Because you need to know that return inwards is affiliated to sales. So you sold something to somebody, the person is returning it back. You remember? Now, there is a note for that. Do you remember that what we learned? Credit note, debit note, all those notes. Which one do you think this one will be? So we learned that when a person is issuing a credit note, who does it come from? The supplier. So you have to be very careful about that. So it means that when you return the goods to the supplier must give you what we call what? A credit note. So do you understand it now? So if the question says that a credit note was given to so and so limited, then it means that he has returned some of the goods. So that is what you need to be careful about. So if the supplier is giving us a credit note, then it means our company returns some of the goods to the supplier. So you have to get that one correct. What if we sold to a customer and the customer returned some of the goods? What do we do? because we will be the ones to now issue the note. We will be issuing it. All right. So the credit note must come from the supplier. All right. So basically that is that. So the supplier. Then the debit note must come from who? The buyer. Oh, sorry. In terms of the dealing with the customer, that is how it happens. All right. So the debit note kind of issued by the company receiving the goods. So technically, let's say the customer, all right, because if I now sell to you, you that is receiving, all right, that is how it will be. You are the one receiving the goods. So let's say that, let me make it more illustrative so that you can understand. We have company A, company B. Company A sold to B. So when he sells to B, what will he do? He will issue an invoice, all right? And we are talking about credit, all right? So that is that. So it means that as far as this one is concerned, company B here is a customer, and company A is what? A supplier, all right? Now, once you sell to this guy, you issue to him an invoice. Now, you've given him an invoice. In your books, what do? You create your account, all right? So you did a sales and there is a data. So the debit will be the data and the credit will be what? Sales. All right, so this is what will happen. Now, this guy is a customer. In his book, what do you think he has done? He bought goods, so he will debit goods. He hasn't paid yet, so what will you do? You will credit what? The creditor, which is company A. All right. So now this is what happened. The goods that this man bought, he has returned some. Have you seen that? So now that he has returned some, what do you think is going to happen? We need to reduce the amount he owes us by. So that is what is going to happen. And since we are going to reduce this guy, what do? We credit him. And that is the meaning of what we say you have a credit note. So that is it. So who do you think issued the credit note? The credit note was issued by who? The supplier. All right. You understand now. Now, this guy thought he was owing this creditor a huge amount. Now, this guy has given a credit note, meaning that he has reduced the money that he is owing him by. So what is going to happen is that he has to reduce the amount he thinks he's owing, and that he's going to pass what? A debit note. So have you seen the difference? So the credit notes come for the supplier. The debit note is from the one who is what? Receiving the goods. All right. So basically that is that. This guy is the one who received the goods. So basically that is that. He's going to use the debit note to actually reduce this credit account. It's like a discount, so sort of. All right. So basically that is that. So you need to understand what a credit note is. A credit note is always reducing your receivables. All right. So take note of that. So we use that thing as a sales returning words. All right. So bear in mind, the most important thing you need to understand is that it is used to record goods return on credit. So the goods that was sold here, you return on credit. Now, what if you are the one, you the company, you are the one returning it to your supplier? Then it means that one will be what? Purchases return what? Outwards. Okay, so it is leaving you outwards. All right. So return on goods purchased on credit. That is it. So we've done two things now. We've talked about the sales journal, and the sales journal records sales on credit. What kind of sales? Inventory sales. All right. And so the opposite of that, people returning some of them, is called what? Sales returning words. All right. So get to know that. Now we learned also that about the purchases journal or the purchases daybook, which is about purchasing goods on credit. What if I purchase and I send someone some of them out again, maybe or because of default or any reason? Then what does that become? That one becomes what? Purchases return what? Outward. So sales goes with return inwards, purchases goes with what? Return outwards. Bear that one in mind. Now, the next thing we need to understand is what we call the general journal. You see, we talked about purchasing and sale of goods. What about it is a purchase but it's not on goods? Still on credit. but it's not on goods. What about we sold, but we didn't sell goods? Still on credit. Then it will go to what we call what? The general journal. The general journal has so many uses. Like you see, we use it to record the opening balances, all right? So uses of general journal, you need to learn that because these things are theoretical questions, all right? Uses of the general journal. Number one, it is used to record what? Opening balances. Not only that, it is used to record the purchases and sale of assets. Which type of asset? Non-current asset or fixed asset, all right? On credit, don't forget that. Purchases and sale of fixed assets or what we call non-current asset is the same, okay? Non-current assets bought or sold on credit. So on credit is very, very important because if it is cash, it will go to the cash book. All right, so those are that. Again, we use it to correct errors, and it's something we will learn very soon. Correction of errors, all right? Correction of errors, very, very troublesome topic, but very easy to, all right? We use it to do correction of errors. All right, so that is that. We use it to pass adjustment. All right, we use it for non-routine transactions, and we use it for closing entries. So these are some of the uses of a general journal. All right, so get to understand that. Then we have the cash book. So this cash book records everything, whether it is asset or good, so far as we paid cash. All right. So whatever you receive or whatever you buy, whatever you sell, so far as it is cash, it will go to the cash. All right. And we have the petty cash for small transactions. All right. So that is that. Now, there are 3 important notes or 4 important notes I want you to take care of. Number one is that the books are essential for accurate and systematic financial records. So it serves as the foundation for preparing financial transactions. If you get this one wrong, everything will be wrong. So there is another topic called incomplete records. All right. So the person probably keeps only some small books. He doesn't really prepare account, but because you know the day books, you can use the day books to form an accounting structure for the person. All right. So that is that. Now, again, the books of prime entry is not a double entry. It is not where you learn to every debit there is a corresponding credit. The books of prime entry or the day books or the journal doesn't factor in double entry. And that is why we call it incomplete records. So because in accounting, wherever there is a debit, there is a credit. But this one doesn't do debit and credit. No. So understand that. Now, it is, however, the source document for every debit and credit. So that's why in the process, you see that after the day books, we now go and do the ledger because the ledger is where the double entry comes from. All right. So from here, we pick it on, then we start learning the double entry principles. All right. So that is that. So the double entry arising from the prime book will be recorded periodically, daily or monthly, depending on the volume of transactions. All right. So that is that. So a transaction occurs, you record it in the books of prime entry, then you move it later to the ledgers. So for now, let's learn how to record one by one how these day books are. So look at all the transactions. You are going to classify them. Which one should, if it is a credit sales, where does it go? Credit sale of what? Goods. All right. It must go into the sales day book. Credit purchases. What type of credit purchases is that? Credit purchases of goods must go into what? The purchases day book. Return invoice. What is the name I say call it by? Sales return invoice. So enter return of sales goods that you've sold. What else do we know? Sales return, purchases return outwards, the same thing. Cash payment and any other one will go into the general journal. Then we start drawing our sales ledger, purchases ledger, then we will do our general ledger. A cash book ledger is there. The cash book serves as a journal in itself and a ledger in itself. The cash book serves a dual purpose. So take note of that. So what are we going to do? We are going to learn how to record a journal. All right. So we're going to start with the sales and the purchases. Then we will move on to how to bring in returns. Then we move on to do how to do the cash book, petty cash, the general journal, and we will now learn how to prepare the ledgers. All right, so now let's pick this question up. Very simple question. I'm going to show you the format of each of the journal, then we start with it. Are you ready? Sit tight. Now, for the sales journal, the purchases journal, sales return inwards journal, and the purchases return outwards journal, this is how we will be drawing it. So this is how we will go about it. So you put the name there, all right, whether it is sales journal or what do you call it, the purchases journal or sales return journal or sales purchases return journal. You just put the name there. So this is how it will be drawn. So you have it. So the first side here will take your date, the date of the transaction. Then you open another column we call the particulars. All right, always try and open that one up small, particulars. Then you put in what we call the ledger folio. It's like just a reference number. You don't need to really put something there. It's not by force. Call it a ledger folio. Then put some small details here and put your amount. And when you do the amount, put in your CD sign. Now, sometimes people put the details here in the particulars position, no problem. But it's just that sometimes the things that happen in one single day is plenty. So if you do that, you can put this place together as the amount. So 2 amounts. So you do something here, then you push it to the side. So you can put the details here and put another amount here, no problem. All right. So let's use this illustration as an example. So you see here that we are doing the day books for these are the information from the books of attachment. And so if you check, there is buying on credit. So that means that we need to prepare a purchases day book. So we can call this one the purchases day book or purchases journal. All right, whichever name we can give it. Then because there is a selling too, you open a sales day book. You see, the word is day book, which means that every day you must record something. Every day. So what happens every day? Like the way when you enter some shops, the person has some notebook there and you'll be recording anything that happens during the day. So that is what we are talking about. So dates, particulars, or details, whichever one that you put. So because of that, I'm going to do it like this. So I can call here details. All right. Then put my ledger folio here. Some even add reference column again. Then instead of putting details, I'll call this one amount and amount. All right, so that you don't get confused. So it means you can do this style or this style. All right, so it's all on you. So we are now going to start how to record. All right, so let's read it. So what we do is this. We read. So January 1, bought 100 bags of sugar on credit from Johnson at 70 per bag. Invoice is subject to 5% trade discount. So let me use this opportunity to educate you about discounts, all right? So be careful of the discount that is in the question. Now, what you should know is that there are 2 types of discount. There is the trade discount and there is the cash discount, all right? Now, note that anytime the word is involving cash, where do you think it will go? Yes, your guess is as good as mine. Cash book. So the trade discount goes to the cash book. The cash discount goes to the cash book, but the trade discount is about your ledger, all right, or your day books here. All right, so take note of that. Cash discounts will always go toward the cash book. All right, so cash discount doesn't affect the sales, all right. It affects the money, all right, at the time you are collecting. So trade discount is given so that you can buy more, all right. Then the cash discount is given so that you can pay early. So one cash discount is for prompt payment, trade discount is for quantity, all right, so for you to buy more. So we start bought goods, so we put here. So what you do is that this is 2018, so write on top 2018 like this. So the first one is January 1. All right, so what happened? So bought goods from 100 bags of sugar from Johnson. So then the only thing you do is that you say that 100 bags of sugar. All right, then probably you put Johnson there. All right, so that's all. The ledger folio, you can create one for yourself. You can say 001. Then the amount, what do we have? So this is where I go like, so you will do 70 cedis multiplied by 100. So that gives you what? 7,000. Now, remember, this is subject to a trade discount. So what do? You will do the discount. Discount of 5%. So what is 5% of this? So 0.05 is 350. So it is supposed to reduce the amount. So this is where I do this and I put here 6650. So this is why I create the two columns. All right, so basically that is that. Now in January 6th, they bought goods on credit from Solomon 500. So when you are doing your description here, what do? You say 100 bags at 70 cedis. All right, so that the person will understand why 7,000 is here. So make sure you add that. All right, it's very important. You don't do any lining. You just come to the next date of purchases, which is January 6th. They bought goods. So goods from Solomon. All right. So goods from Solomon. They said 500. This one is not per or anything. So it's straight 500. That is it. Then they sold goods, 80 bags of sugar on credit to Philip. So this one is January 10. All right. So what you do is that so 80 bags of sugar at 85 cedis each. Who did we sell it to? Philip. All right, so you can also put here. So let's say this one is purchases, so like something like P001. This one, I'll call this one P002. So this one, so let's call it S001. There's no law to that. You can decide to do whatever you want. So here we have 80 multiplying by 85. So that gives me 6,800. So is there discount? Yes. So 6,800. Then you have discount. Here we have trade discount. So you can call the other one to the same. Discount at 4%. It means if you do that amount multiplied by 4%, you have 272. And what is the amount minus this gives me 6,528. So that is how you go through it. Then they said they sold goods to Asante again. So sold goods to Asante, which date? You have January 15. So goods to Asante straight 390. All right, then there is on January 19th, what happens? They bought goods from on credit from Johnson again. So goods from Johnson. So I can call this one P003. Now there's no law to that. I decide to do it anyhow. So this is it. Once you are done, you just total the thing and you are free. That's it. All right. So you total the amount here. So what do I have? We have 6650 plus 500 plus 610. So that gives me 7760. And here too, I had S002, right? Yeah, you can create one for yourself. So I have here 6528 plus 390. All right, so that is 6918. Cool chop. That's it. That's it. So what we will be doing is to pick a full question. And in that full question, we will be looking at something like this. So this one involves returns. All right. So in the next concept, we will look at the illustration 2, where we have in here the person bought all these things. He bought all this, he returned some. So you open another one, a return inwards or a return outwards account. So this is it. But for now, what you need to understand is that you have got to know how to do a sales day book and what a purchases day book. So you do the same thing from the return inwards. So if they returned, you create a return inwards journal. All right. If you also return, you create a return outwards journal and you record something like this. All right. So see you in the next video 3, where we take a full question. All right. So after that, then you see we are supposed to prepare a sales journal, purchases journal, return inwards journal, return outwards journal. So you create this journal. It's not difficult. You can actually do this. So let's practice little by little, then you can get it perfected. After the journals, don't forget, we'll move on to a ledger. All right. So see you soon in the part 3 of the accounting process. Bye-bye.